And mostly the process of formulating regulation is you're able to identify the risks, and then you build up a model. You build up a model to regulate those risks. So if you look at the digital credit space, you have risks on the demand side and you have risks on the supply side, demand side being the customers. So some of these risks were, for example, their private information being abused by third parties, or you have the borrowers not fully understanding the nature of the credit product. So that lack of transparency was there. And then you have the third one where borrowing beyond the repayment capacity led to a negative credit rating. And then when you look at on the supply side, which is now the providers of this digital credit, there was non-repayment. So therefore, they would make their own predictions as to whether Fiona can repay this loan, but sometimes it reaches a point I don't pay it. So they face that risk. And then the second one was the absence of free-flowing information, because when you look, it was very hard for them to get, say, information, because information from the Kenya Credit Bureau, because maybe other lenders as well are not submitting this information. So those two risks and what Steve talked about was some of the reasons that led to this regulations called the Central Bank of Kenya Regulations of 2021. Okay. So I'll go now into the contents of the Act as I wait for the next slide. And the first one is licensing. So when it comes to licensing, upon the commencement of, let me go back to exemptions from this regulation. So the ones who are exempted from this regulation are those that are licensed under the Banking Act, Microfinance Act, and the Circle Society Act. Then you have the Kenya Post Office Savings Bank. Then you have the credit arrangements that involve the provision of credit by a person that is merely incidental to the sale of goods or provision of services by the person. So here you can take an example of, say, hire purchase. So if you're going to buy a particular product on hire purchase, then it doesn't fall under this regulations. Okay, then now I'll go into the contents of the Act, and the first one is licensing. So first, the digital credit providers are not allowed to collect any deposits. And once this Act is in place, any person who carries out the digital credit business and doesn't have a license is actually considered to be doing it in an unlawful way. So once this regulations will be in place, then anyone who's been operating a digital credit business has about 60 days to apply for registration. And this application process attracts a fee of 5,000, and then after that, there's an annual fee of 20,000. And unless there's a reason why the license has been suspended or revoked, it's just considered that the license remains valid. So what does the application process look like? There's a form in which, as a digital credit provider, you're supposed to fill. And in that form, there are certain details that they collect, such as, say, the name of your company, the certificate of registration, the date of incorporation, and then also it looks into your shareholders and your directors, and what are some of the academic qualifications that they have, what are some of their previous employment experience in which field. So it does a thorough background check, especially on your directors and the persons who will be in charge of running the business. So then, of course, once you submit the form, the digital credit provider is also supposed to certain documentations, just to go with what you said. So if you said this guy is ID number this, you you have to provide a copy of, the ID and the certificate of incorporation and the rest. Now, when it comes to the directors and the chief executive officer, there'll be some sort of background check as to, have these people ever committed a fraud? Have they ever contravened the law in any way when it comes to protection of members of the public against, say, a financial loss? Or was the director part of a company that was formally liquidated? So that will be part of the process as to whether they actually give the license to this digital credit provider. And then now when it comes to the revocation of the license, one of the ways that your license can be revoked is whether during the application process you gave false information, or you contravened any of the licensing conditions, or you cease to carry out business as a digital credit provider, or you're carrying out business that in a way that is detrimental to your customers. Okay, next. Then the second segment is confidentiality. So here, all the stakeholders, which are employees, directors, or any agent that is acting on behalf of the digital credit provider, they are supposed to protect the confidentiality of the customer information and any transaction. And if they're to share this information, then they should only do so when they've gotten that customer's consent. So personally, I think for me, this is a clause that is welcome, because there was that in our earlier discussion. You remember that one of the demand risks was that this private information is being abused by third parties. So I think this is it's a very welcome clause. And then the third part is the customer consent. So here it's in regards to whether or not the digital credit provider would submit negative or positive information to a licensed credit bureau. So the process is that, say I'm the provider, so I'm supposed to first inform the customer 30 days before I submit this negative information, and then the customer, through, say, oral or print or electronic means, they agree this information to be submitted, and then I submit it to the credit bureau. Then I go back to the customer and I inform them within 30 days after it has been submitted. Now, for this particular one, there's a segment that says any amount less than 1,000 shillings should not be submitted to the credit bureaus. So there's a study that was done in 2016 by TransUnion, and they actually showed that 400,000 Kenyans had a negative listing on CRB because they failed to repay a loan of 200 shillings. So that was the average. So, and the consequence of having such a credit listing is that it locks you out as a lender from now the regulated credit market until now that amount is paid. So there were trivial amounts. So probably I'm eager to hear what Kevin has to say about this 1,000 cap, whether it's too low or it's too high or it shouldn't be there. But yeah, so I'm guessing that's what informed having to keep that cap there. And then the fourth part is the place of business. So which is that the digital credit providers should have at least one registered physical office in accordance with the requirements of the Companies Act. And then the fifth part is now the digital credit. Move to the next slide. Yes, the fifth part is digital credit. So here, the provider is meant to disclose all the terms and conditions. So this has things to do with the charges, the fees, the interest rates, whether this interest rates are, whether the amount payable is due is on a reducing balance or not, what is the total cost of the credit, just separating the principal and the interest. And this is also a very good recommendation, because you find that for some digital lenders, some would provide, others were not providing, and then you therefore get that, you know, the customer does not know the entire nature of the product that they are consuming. So therefore, in a bid to improve that transparency, I think this is very important, because it does away with the information asymmetry that, you know, the provider of this credit has more information than me as a customer. And then also now, in regards to an unperforming loan, there's now a sum of how the digital credit provider can get. So this is the interest. The interest should not exceed the principal owing when the loan becomes non-performing, and any expenses that the provider incurred in the recovery of any amount. So they'll do a lump sum, and then that's what the customer will pay. Next, credit collection. So in terms of debt collection, now here you had a lot of there's a segment of the population that felt, you know, these digital credit providers are using some unethical debt collection methods. They were harassing people, you know, they were even probably texting your relatives or your friends in order to, just for them to get their money back. So now there's a whole clause on debt collection and what they are not supposed to do. So there's no use of threat of violence. You have no use of obscene or profane languages, and the rest that are listed there. And then the other segment is now consumer protection. So here is where now the digital credit provider is expected to put a mechanism in place in which consumers can be able to communicate their complaints, and this mechanism should also be known to the consumers or the customers. So where now there's a time frame as well, where the customer complaints should be addressed within 30 days, and the provider should then keep a record of all these complaints and how they were solved. And then there's also the aspect again of information, whereby the customer should be made aware of the benefits, the prices, the risks, the terms and conditions should be clear, fair, and transparent. So again, here they are trying to solve the aspect of transparency, because there were also some digital credit providers where, for example, if I don't pay a loan, and I think this used to happen with M-Shwari or something, then you're locked out of your savings account, or you find that sometimes when you make a deposit, they were auto withdrawal, and yet the customers were not aware of this auto withdrawal policies. And also it's just important for that separation of, you know, this are the prices, these are the interests, because then I can even be able to compare. So I know so and so offers this at this rate, so and so offers at this rate, so I'm able to come up and make that choice. And also this will also lead to trying to reduce some of these rates of defaulting that has been there. Now the last part is on economic regulation. So the question we're trying to answer is, when you look at these new regulations, do you feel as if they will meet any of the reasons why we oops. Sorry about that. Okay, I'm back now. So I was talking about the 4 reasons why for economic regulation. So the first one is whether there's a natural monopoly. And here mostly they regulate because of abuse of dominance, which doesn't apply to these regulations. And then you have externalities, whereby the actions of a particular firm affect a third party, which is also not very clear in this act. And then you have public goods, which these are goods that are non-excludable or non-rivalrous, which just means if you can exclude someone from enjoying the benefits, and then non-rivalrous meaning that my consumption of this particular good then reduces reduces someone else using it. So if you look at the digital credit space, the good and service that is being provided here is actually a private good. So the main reason why government is regulating then falls under the information asymmetry. So whereby you have that this digital credit providers have this information which the customers doesn't have, so they're trying to mitigate that by having all these regulations from the segments on consumer protection, from the digital credit, what the customer should be aware of, talk about customer consent, talk about confidentiality. So a huge chunk of this regulations are talking to the reason for information asymmetry. So in conclusion, I think that these regulations are in order because they do serve a purpose into why government. So thank you so much. Back to Steve.
Thanks a lot, Fiona. Thanks a lot, Fiona. I think he has done justice to the regulations as they are. As Kevin is preparing to take the stage for his part of the presentation, let me try just to sum up in a few words what we've gone through. And for me, I think the most important aspects of physical office is key, because before then, some are just briefcase organizations applying the trade. So consumer protection, insofar as, of course, your consent is required, sharing information, and also in the manner in which these digital lenders are allowed to come back to you and try to recoup the loan that you had actually gotten from them. So without much further ado, Kevin, if you are online, I can see you. Hi, hello, welcome to this webinar. Kindly take the stage and just give us highlights of what you think this regulation portend for the industry.
Good morning. Can you hear me?
You are muted, kindly.
I'm not muted on my end. Can you hear me?
Yes.
Okay. Can you see my screen?
Loading.
Okay. Good morning, everyone. My name is Kevin Mutiso. I'm an entrepreneur, but these days I wear two hats where I also serve as the chair of the Digital Lenders Association of Kenya. Steve, kindly tell me when the screen is, you can see my screen, huh? So thank you very much, Fiona, for that wonderful presentation. I actually thought I was going to do that as well. So I'm so happy that I don't have to, because as I introduced myself, I am not a lawyer. And so sometimes I find the legal jargon overwhelming, like I'm sure most people do. I'm a simpleton, I'm an entrepreneur. I play the game, for lack of a better word. So what I'm going to do today is, Steve, please confirm that you can see my screen. Let me try again.
Yes, we have it on now.
So my presentation today will be along a few parameters. So who is DLAC? What do we do, and what are we about? The new law, which has been taken through in detail. So I won't go too much of that. But I'll speak about what's missing and why it's missing, what it is now, and the next steps, right? So we formed in 2019, and our idea was to build on the good work a lot of visionaries had built. As you know, Kenya is is a sort of like a financial services hub. We were at the forefront of microfinance, then mobile money, now digital lending, and I'm certain we're going to be at the forefront for a long time. And so it was, how do we then be part of that narrative and contribute to that conversation, not just locally, but globally? The main objectives were to set and instill ethical and professional standards. The industry was evolving very quickly. When I launched my business in 2016, we were 4 of us. Today we're over 100. And between 2016 and now, we've had at least 400 come and go. We wanted to collaborate with policymakers and other stakeholders in addressing existing and emerging industry-centric issues in a collaborative manner. A good example here is at the height of 2021, sort of mid-2021, there were a lot of complaints around debt collection practices and being harassed, etc. I'm certain that you have all noted that it has calmed down considerably. And I attribute that to partnerships across the board, where we are working with mobile money providers, for example, to turn off pay bills of rogue lenders who are sort of contravening the DPA 2019 and now the CBK Amendment Act 2021. So that's the collaborative manner I'm talking about. Contribute to knowledge and learning in this space. We've released over 5 different reports, the most notable one being a PwC report where we looked at 11 markets and how those markets regulate the fintech and digital lending space. Of course, drive overall growth of the digital lending and fintech center in Kenya in line with MTP3. We are now going into NTP4 with the new administration coming in later in the year. And then, of course, to drive investment in the sector. And this is a big thing. What many people may not know is that the world is awash with a lot of capital, about $2.2 trillion of money, cash, dry powder, as we call it in the game, is sitting, earning no return. And then about 14 billion, about 14 trillion in assets are earning negative yields. And when you talk to the owners of this capital, the big issue they have is One, they have a minimum size of investment, so they want to start. They don't want to invest $1 million, $2 million. They want to do minimum tickets of 50, 100. And then to get that type of investment in any type of business anywhere in the world, to de-risk the investment, they prefer regulated entities, particularly if you're in the financial services sector. So for us, this is one of the key reasons why regulation was important to us. We wanted to be able to tap into this capital wells that exist. That's our membership. I won't speak too much about it, but I keep telling people, particularly those who have reached out to me to try and help them deal with the harassment of texts, stop using non-DLAC members, and now do not use non-licensed members as of September 2022. I wanted to also walk you through quickly the state of digital lending so that you sort of get a sense of where we are. We did a poll in 2020, 1,000 people, and some of the respondents gave interesting insights. So nearly half of the sample respondents mentioned that they would not have another credit option if not for the mobile phone. And that's an important key, a piece. This tells you about the evolution of the financial services sector here in Kenya. I'm privileged to have traveled into some of the fintech hubs in the world, like the UK, China, Singapore, and I can tell you for a fact, if it wasn't for the small size of tickets in terms of, the average loan size in Kenya, for example, dollarized is $40. It doesn't show the state we're in terms of use of AI and data and algorithms. It doesn't show the penetration. We are way, way, way advanced. And with this new regulation, we expect to be at a new level at the global standing. Anyway, so some quick numbers. 83% of respondents expressed high satisfaction with their mobile experience. I'll tell you why, because 83% pay on time. If you look at the numbers at the CRB, you've got about 16 million records, 16 million individual records. What that tells me, or what that tells anyone in the industry, that there are 16 million human beings who have borrowed and repaid. And the issue that we keep getting in the media is the 4 million who are actually listed as defaulters. So that's the key differentiator. So 83% are happy. As you can imagine, if you're not paying on time, then you're not happy. Obviously, because you're being, it's a spectrum from being asked to repay to being harassed to repay. 55% of those who use digital loans use it for business purposes, and 84% of the small business borrowers stated that the loan enabled at least some growth in their business, with nearly 30% expecting a 2 times return or more. And remember, this is in the informal sector. So when you say 2 times, you're saying 10,000 shilling in profit to 20,000 shilling in profit. And when you have margins of 50 to 100% in some games in the informal sector, that is very possible. And then some key numbers. Total respondents have credit options other than mobile phones. 41% are in the lowest economic segment. 90% believe that they have more credit options than they did 5 years ago. And 96% believe this is a positive thing for the business or household. Okay, now to the reason we're here. So I'll give a quick overview. So the CBK Amendment Bill was introduced into Parliament by an MP known as the late Honorable John Oyoka. He passed away. And his objective was to try and license digital lenders because of, as I said, the bad behavior that was in the market. It was then taken up by the Finance and Planning Committee that is chaired by Gladys Wanga, and it went through the 3 processes. So first reading, second reading, third reading, and it was passed into law on December 17th. And then the CBK released the first draft of proposed regulations, which is what we were taken through by Fiona, and the final draft shall be released before March 23rd, so that the the regime starts on March 24th. So I think the key things that we were able to remove or have made a good case to have removed to the various committees that we dealt with during the creation of this law was we were able to remove prudential guidelines, liquidity ratios, and provisioning guidelines. The reason for this was, for the first two, prudential guidelines are for companies that take public deposits, therefore need to show the regulator that they have liquidity in the event that the depositors want their money back, right? And that's the same for liquidity ratios. And our argument was we are using our private capital, therefore do not need to be subject to this type of regulation. And if anything, would increase the cost of lending. Why? Because it means that I have to hold my private capital as a deposit in the central bank, knowing that it will not earn me any real return. Therefore, I have to take the return that I expect from that capital and amortize it on the rest of the capital to ensure that I'm paying the full cost of capital. And then provisioning guidelines. This basically tells us how to provision debt as it ages, and it has significant impact on our P&L and therefore the balance sheet, because if it sort of tells you what to write off, when to write it off, and how much you can write off in terms of P&L. So it has a tax benefit in the short term, but if it's too strict, it has a very bad effect on your P&L, so therefore you cannot report a profit. And the way our game works is that if you are unable to report a profit, you therefore cannot get more private capital into the business to continue lending. So those are the main things that we're able to make a case for, and we're very glad we were listened to. Now, in terms of the CBK Amendment Act draft regulations, I think there are some key things that were spoken about, but I want to just bring them back to your attention. I foresee a situation, and the lawyers can tell me, where we'll have concerns around the definitions. So what is a digital credit provider, digital credit, and digital credit business? Why do I say that? In financial services, particularly in lending, you have three main players. You've got the banks, four main players. You've got the banks, you've got the SACCOs, you've got what you call the non-deposit taking microfinance, and then, of course, the digital lenders. Now, the banks and the SACCOs are regulated. The deposit taking microfinance are regulated. Who aren't regulated are the non-deposit taking microfinance and the digital only lending institutions. And this law was created for the digital lending piece. But what is now playing out and is likely to happen is that the non-deposit taking microfinance may fall under this law, under the definition of digital credit business, which means the business of providing credit facilities or loan services through a digital channel. And the argument is that if you're using a digital anything, be it M-Pesa for disbursements, you are considered a digital credit business. So that's going to be interesting, and I can't wait to see how that will be solved in the next few months and weeks. Of course, then there are the exemptions. Fiona took us through them quite well. There's rumors of an NDTM regulation. Therefore, the idea is that if you're under this regulation, you will be exempt from the NDTM regulation. The NDTM regulation is provided for in the Microfinance Act, where Treasury is given the powers to create regulations for credit-only institutions. That has been the works for nearly 7 years. I'm not too privy about what and where and what has happened. I just know that things sort of overtook, digital lending sort of took over the narrative in a sense, and now we have the digital lending law. And then I highlighted the other sections there so that if you're a business person, not a lawyer or an economist, more of a business person, you need to understand definitions, exemptions, the licensing piece are very critical. Of course, then you need to understand part 4, part 7, and part 8. Why? Because those will be critical for 1, getting the license, 2, staying in business, and 3, just making your life easier. And it also tells you where your costs will come from. Now, from the business point of view, remember, compliance means cost. We're not complaining about the cost, but I'm just highlighting that it does mean cost. So those would be the main areas where cost would be derived from. Great. So now, what were the submissions of the Digital Lenders Association of Kenya? Kindly confirm you can still see my screen.
Yes, we can go ahead.
Great, and I hope I'm not talking too quickly. So great. So under the 2010 Constitution, free enterprise, the right to free enterprise is a right. So to do business is a right. And then, of course, any regulation or law that is brought before the people, whatever that means, has to go through the public participatory process, which is a fantastic thing. If you've been in business in a long time, like I have been, you remember the days where you could not comment, or you had to sort of find a way to talk to somebody to explain to them how this business model works. Anyway, today we have formal channels, and we engage very maturely. Don't believe what the press tells you. And so what we did, as the CBK requested, was they wanted our submissions in on the remarks on the regulations by the 21st of January, which we did. So what I'm going to walk you through are the comments. The comments are sort of summarized along 4 lines. The first one is harmonization. So what happens with the law is you want to avoid conflicts with other laws, particularly if the law is referenced to in the law that you're reviewing. So for example, here you've got the Data Protection Act 2019. So there's some harmonization that needs to be done there. Then there's negative consequence to the business. So the way we look at it, the way we look at regulation is, what does it do in terms of my business model? How much control of the business decision is taken from me, the business owner, and has to be sort of given to or managed by the regulator. And so those two have a negative consequence. Why? If you have too high a cost of regulation, what that creates is it means that you have to have more capital. Therefore, you need to have sort of more of everything, and that just means there's a higher cost of capital. You have if you fail, the cost of failure is higher. Blah blah blah. And then, of course, on the other side, when it comes to negative business decisions, the regulator's mandate is market stability, price stability, and in some instances, jobs creation, like the Fed in the US. So when you look at it from our perspective, our mandate is to ensure we're delivering a good and consistent return to our shareholders without harming the citizen of whatever sort of state we're working in. So, so that's what I define as negative consequence. And then the third thing is adding something or additions that could enable innovation. So those are the 3 things. So I won't walk you through everything. I'll walk you through what I think is important. And then, as I promised Stephen, I'll share this. And I'm happy to take questions. And my legal team is also happy to take the legal questions. Right. So I'll go straight to number 9. So suspension or revocation of the license. The bank may suspend or revoke a license of a digital credit provider if the licensee, and then it has A to H. And what we're trying to say is, so in the middle section, it's what we are proposing, so the change of language. And that's how you make submissions for these types of things. you delete language and replace it with what you think is preferred, and then you give your reasoning in the last column. So the language we propose is there. So we would like to cease to carry on the business of a digital credit provider, goes into liquidation, or order to is issued for winding up. Why? We think the license has some value. This license, I don't think, will be one of those things that will, I wouldn't use the word easily come by, but it'll take a bit of time to get it, to get the license. Why? Because then you have a capacity issue. Remember, at the end of the day, you have humans on the other side at the regulator side, and there's so much they can do. And so if we have 100 lenders, as you know today, they have to go through, and Fiona went through fit and proper. You saw the form that they have to go through. So if you have to go through for 100 companies, and each company has, say, 5 directors, maybe 4 people in escrow, you can imagine the amount of time it will take, and that's just one section. So we want to sort of not, that the revocation of the license doesn't happen if the business stops for whatever reason, or goes into liquidation, because the license is valuable. So the idea is that the ability to trade it. The second is has received a final decision issued by the data, so has contravened any of the provisions of the Act or regulations made there under relating to digital lending. So as a general comment, the violation of the Data Protection Act is very broad, as the Act regulates many issues related to data processing. We are of the view that no action should be taken by the CBK until a final decision has been issued by the Data Commissioner, as digital credit providers will have to follow a separate process in relation to any data protection concerns with the ODPC. Until that process is complete, it would be premature for the CBK to assess the situation and the impact it may have on a digital credit provider's license. And that makes sense, right? So we're going to be, all businesses now will be regulated by the Data Commissioner's Office in some way or form. And if you're found to be in breach, there's a process that you have to go through that even has an appeal section. So if that happens, it would be unfair that the license is revoked before we are found to be in contravention of the Data Protection Act if it's a data protection issue. I hope that makes sense. Go to number 10. Number 9 again. I've sort of walked you through what we want, and that's the preferred language, right? Number 10, sorry. Amalgamations and transfer of assets and liabilities. So the clause reads, a digital creditor should not enter into an amalgamation or an arrangement to transfer all or any part of its assets and liabilities to any other entity except with the prior written approval of the central bank. Again, it's not that we don't trust the CBK here, it's just more of a, like, how long will it take? And the moment you add time to the variable, there's an expense issue, and if it's not sort of cast in stone what that timeline is, if the variable is 1 day to 365 days, or maybe even 1,000 days, there's a real cost to that decision taking that long. So we're proposing again, and again, maybe I should explain this. What this means is that I'm a lender. I've built a book of 200 million shillings. It's a good book. It gives me a return of 2% per month, gross of expense. And then net of expense, it's probably 0.5. I want to sell it to a much larger lender so that I get more money to continue lending to my existing customer base. So this helps with liquidity. And potentially what you could have is secondary credit markets, which would not be a bad thing if properly regulated again. And so what we're saying here is kindly allow us to enter, secondary credit market arrangements as we wish, so long as we're not breaking any of the existing laws that are in place. And the reason we don't want the written approval is because of capacity. And again, the argument that we do not collect funds from customers, we don't take deposits, therefore should not be of a concern to the regulator. The 13 is credit, exchange of credit information, and the clause, as reads as is. So what we really wanted, so this is effective because March 2020, we were removed from the credit information sharing mechanism. It had real consequences to our P&L. Some of us even shut down and have only restarted in 2022, late 2021. And so what we wanted to do is ensure that, one, we stay in the credit bureau, and we can access the credit bureau. The only comment we had was around the 1,000 shillings, and Fiona did mention it. Let me give you context. So 1,000 shillings, and you used the word trivial. 1,000 shillings over to 1,000 people is $1 million, Bob, right? So it's trivial when you look at it in the individual, but when you look at it from the business point of view, it's $1 million shillings, so not so trivial. Secondly, the way it works in our business is that we have to build trust with the customer. So let me use Stephen, for example. If Stephen came to my platform today, and he has never borrowed before, but his initial data sets tell me or tell the business that he is likely to repay, right? We would want to give him a loan that is low enough not to affect our existing profitability, but high enough to solve some problem for him. And you find in the informal sector that amount is as low as 200 shillings, 500 shillings. Now, when you can't submit data below 1,000 shillings, what you're basically telling me, the lender, is that, okay, so don't take bets on people whose upper limits look like 2,000, because before you figure out that that potential customer can get to 2,000, you sort of need to lend to him 200 or 500 shillings. So a large segment will be left out. There's the moral argument that they should be left out. And that's why our members, our language there was very deliberate. Our members have raised concern. So I hope my concern is understood. But we do recognize that moral argument of should people be taking loans of 500 shillings, $5. But again, I think that moralistic argument comes from a place of privilege. If you speak to the guy at the ground, he'll tell you something very different. So I hope that the powers that be are looking at sort of talking to those demographics before they make some of these decisions. I can tell you that I don't think it's a good idea to not. I think it should be scrapped. Of course, then there's customer consent. We wanted to just eliminate oral because what does oral mean? And it could create a whole set of problems from a court perspective if we're ever sued. So we wanted that removed. 16 place of business. So what we don't want is the approval. Why again, the cost of the decision-making process. What we'd rather is a notification. And then if approval is required, we would like a timeline. The reason for the timeline, I think, is now very clear. And then 17, provision of credit. So this is usually the touchy one. So the provision of credit is the core of our business, and therefore any intent to sort of take over that process scares us, scares me, the entrepreneur, scares the investor, and scares the general ecosystem, because we should, if anything, be in control of that one variable, which is the core business. And so our proposals are around that. So in the second column here, Fiona already read all these, so I'll focus on these. A digital credit provider may set borrower limits in its credit policy, right? So remove and shall comply with any requirements prescribed by the CBK. And then 3, a digital credit provider may extend loan to its customer subjects to its credit policy and shall provide clear disclosures of the terms and conditions of the loan to the borrower, including charges and fees, and the circumstances under which they may be imposed. Right? So again, what's critical here is just, we don't want any regulatory piece, oversight when it comes to, not oversight, we don't want to be held back by the CBK when making these business decisions. I think we have good laws already in the country that already provide what a good contract looks like. And then what we should enter into is a contract that follows a particular set of rules. And those rules are already very clear. If you go to the sections I mentioned earlier, you'll see consumer protection, data privacy, etc., etc. And so the credit policy, credit approval by CBK is something we're quite averse to, simply because it's a business decision, and business and changing markets need quick decisions sometimes, and it would be a risk. Hope that's clear. The limit on interest recoverable from non-performing loans. So the maximum amount is the sum of the following: the principal owing when the loan becomes non-performing, interest and fees, and in accordance with the contract between the customer and the digital credit provider, not exceeding the principal owing when the loan becomes non-performing, and expenses incurred in the recovery of the amounts owed by the consumer. So this is ad duplam. Basically, if you borrow 100, please do not collect more than 200 shillings, including interest, fees, and expenses incurred in the recovery, which is fair, and that's the suggestion there. So we just wanted the end fees added to the number 2 there, and again, those are very straightforward. The variation of credit terms. We wanted the addition of an unless it is within the limits as specified within the credit policy approved by the bank. So this speaks to, in the event that the bank CBK insists that there's a certain minimum credit policy, we want that clause added, because variation of credit terms basically means that you were already in contract, you're in default, or something has changed in the marketplace where they have to increase price or reduce price, or reduce or increase a fee. How do we do it? And that's what this governs. The rest is pretty straightforward. I want to go to what we're adding: additional regulations, right? So this is what makes us more competitive and more innovative. Number 1 is sharing information. I'll give the reason. So we propose that credit reference bureaus and mobile and MNOs will enable the verification of customer numbers by digital credit providers. And then here the customers are required to provide their telephone numbers while applying a loan. Any customer changes this phone number and does not inform the digital provider, then the digital provider may be unable to reach that customer for collection of loans taken by that customer. This leaves a situation whereby a digital provider contacts an individual who has not taken a loan. Now, this is a real problem. In 2016, for example, what was happening is Stephen would go take a loan on 0722111. Once he gets to the 10,000 limit, he throws away that SIM and goes and gets another SIM card and then borrows again. So what this is saying, or rather disappears, what this is saying is that we need to get a way to be notified through the credit bureau and through the MNO. We want real-time data, so credit preference bureaus share credit information and application data, digital credit providers in real time. The challenge here is that digital lenders are the only ones in the five that I mentioned earlier that lend, the customer walks in and the customer walks out in 3 minutes, they have a loan. So at 8 a.m. in the morning, Kevin Mutiso could have no loan. At midday, I could have loans from 10 lenders. Now, you can't do that in the banking sector. You can't do that in the SACCO sector. You can't do that in NDTM. You can't do that in DTM. And as the way the CRB thing is structured, CIS framework is structured, it's not yet real time. So the 10th lender lending to Kevin Mutiso that morning or this morning would not know that I borrowed in the morning until a month later. So we're saying we want real-time credit. This would make us more innovative, make us manage our risk better. Our biggest risk is fraud, manage our fraud better. And then what I think could be the game changer, everywhere in the world, it has been proven that a sandbox regulation framework allows for future technologies that are coming in and future business models that may not have been captured in the existing regulation to be tested. So what we're saying is, could we have a digital credit and start playing around with different ideas in a sort of framework that makes sense, and it comes under this license. So if you're licensed under this regime, then you have access to this type of sandbox. What I'd say here is, think about what it can do in terms of fintech growth and fintech growth in the sector. The idea of the super app would now be something that would be possible because it's embedded in a piece of legislation. And so the investor, the entrepreneur would know exactly what they need to do. And then the regulator at the same time would not be taken aback and would have a framework on how to deal with these new ideas. Stephen, I think I've spoken for too long, but I tried to hurry it up as much as possible. I'm done.
Thanks, Kevin. Thanks a lot for that wonderful presentation. Actually, giving us a lot of insight into the industry and how these regulations are affecting you. And I can see you made proposals on the same, which are supposed to strengthen those regulations, of course, for the betterment of the industry and to protect the consumer as well. But a few things that come to me as you are speaking that I'd like just to maybe reiterate on is that Kevin has given us a background of DLAC, as we've seen, since it was its inception in June 2019, and then given us some data insofar as the lending industry is concerned, both for new users and returning users in terms of percentages. So as you can see, 83% are return users and 88% actually use digital lending instruments. But what I find interesting, Kevin, is this: when we are talking about the regulations per se, are the definitions, digital credit, digital credit provider, and digital credit business. I think this will be a spanner in the works because, as we notice now, we have a number of SACCOs who have launched their own digital lending services. And they are actually trying, not even trying, but I think the space is now awash with all SACCOs trying to come up with the same. And this will now bring a lot of competition, which is good for us as the consumer. But what does that mean for you in that market? And then the issues I think that we also looked at are three-pronged insofar as the harmonization of these laws to existing ones are concerned, and what that would portend for consequences to industry players. And then lastly, you mentioned about the regulatory sandbox, which for me also I support, because it's necessary that we actually have an environment within which we try to cultivate innovation. Because as you know, there's issues of AI, machine learning, and Internet of Things that are coming up, and this will affect the manner in which the business and the players both for the consumer and the service provider are concerned. So that's it for me. So as I open up for the plenary, I see a few questions here, which I'll pose to both of you. So Fiona, I'll go first. But before I do that, is there anyone who'd like to pose a question? The floor is open. You can unmute yourself. Probably, if possible, turn on your video, and then you can just pose your question. Before I read the ones in the chat box, you can raise your hand. Then I can point at you if you can. Okay, then let's tackle this first as our members and audience are preparing. So firstly, this goes out to you, Fiona, and the question comes from Collins Ye. Colin.Ye. He says that Fiona mentioned about the digital lending license application process. And the question is this currently available for applications? So you can ponder about that as I ask the next question to Kevin. Kevin, you have two. One from Eliud and the other from my colleague Fiona. And Eliud is asking, with the debt collections malpractices that we are still experiencing, where third-party contacts are being engaged, what law has been put to control this? I think that you can tackle adequately. And then Fiona asks, do you think it makes sense to get customers' consent before listing them, especially negatively? As a customer, I could just refuse, then what? That's an interesting. What happens in such a case? Fiona, that's a nice one. So let's start with you, Fiona. Could you answer to the questions from Colin?
Okay. Colin was asking whether the digital lending license application process is this currently available? No, because in the regulations they state that upon commencement of these regulations, then anyone who's operating a digital credit business has about 6 months to apply for registration. So I think from March 24th going forward, once they've finalized everything, is when now one can start applying. Yeah.
Okay, thanks, Fiona. I think that's in order. I hope you are adequately and sufficiently answered, Colin. So Eliud, the question to you, Kevin, from Eliud. The malpractice is going on. What do you think about that?
You know, I love that question because if you knew how many messages I get in a week or from all over the place, compared to what, so I think it's quite a number. So in July, you know, it was almost 100 messages a day. Now it's close to maybe 5-10 messages a week, right? So the answer to the question is, one, we do not condone the behavior. That debt collection practice is actually, it's known as debt shaming. It is done by a bunch of credit lenders that came from the Far East. Initially started in China, they got kicked out, they went to India, they got kicked out, they came to Kenya, and now we are going to kick them out. It is illegal under the Data Protection Act 2019, and it's now illegal. Fiona read the clause beautifully, right? It's very expressly there. You cannot do, you know, send offensive language, blah, blah. It's very clear. So it's illegal now. So to answer the question in a better way, the truth is that the CBK and the ODPC may not have the capacity, do not have the capacity to enforce some of this regulation, right? Why? Because there's a lot. There's a lot of things happening, there are many moving parts. As I said earlier, we've started collaborating with other stakeholders in the ecosystem, such as the mobile money providers that set up the pay bills for these types of lenders. And we have been shutting them down. As recently as last week, there was one lender that was harassing customers, and we received quite a bit of complaints both on the mobile money side and on the deluxe side, and we were able to shut it down using those laws as the reference to why we were shutting them down. And I'd not say me, the mobile money. I've seen a question saying, do I believe that it's illegal to take contacts and whatnot? I don't think this is a moral debate. I think it's more of a business decision. Collecting that kind of data gives us quite a good insight on who the customer is. And I'll give you a very good example. We have found a direct correlation to predicting repayment on how somebody saves the number on their phone. So I'll give you an example. So Fiona is Fiona Okadia. If I save her name as capital Fiona and I save capital Okdia, and then Stephen has saved the same name as small f and small o, I as Kevin will more likely to get a loan before Stephen. Now, we have not found out what the correlation, where the correlation comes from. So, right, but that's how we use data. We're not interested in getting Fiona's number to call her per se on Stephen's phone. What we're more interested in is how does he save the number? How many contacts does he have? Somebody with 2,000 contacts is more likely to be an entrepreneur than somebody with 70 contacts. There's a thing called the Dunbar number, which is 150, which is the number most people like. 150, the Dunbar number is the number of names you can remember at any normal human being can remember at any given time, right? So there's that sort of reference point of the Dunbar number, and then, how many contacts do you have? So that's how we use the data. So that notion that people can sort of go to Stephen's phone and then call Fiona, that's illegal. You didn't give us consent to do that. You gave us consent to take that data and use it for credit scoring purposes, right? So that's the explanation there. And then the third question was consent. If you refuse to consent, then you can't access the product. It's that simple, because we need the data to make the credit decision. Does that make sense?
Yes, it does. Thanks, Kevin. I think Fiona has a follow-up question, but for that, there's a follow-up question from Eliud. He's asking, you share the requirements for joining DLAC. So I think that's something you can look at to do.
Yes.
Fiona, kindly.
I think the question is not on consent when I'm taking the loan, but it's on the clause whereby before you list me as, say, I've defaulted on paying the 2,000 shillings, right? You have to first call me or write it maybe in email or text and say, we are going to list you for not paying this 2,000. And then the regulations are very clear that I have to give my consent for you to do that either orally or in written form. So in this case, if I do not do that, you cannot proceed to, or rather, I'm interpreting that you should not proceed to list me as the digital credit provider. So in such a case, what does that mean? Because I thought that one of the things that maybe you would want scrapped off is actually that segment, because then it keeps you in a, yeah.
So we put that in the contract that you sign before you get the digital loan. So you consent before you take the loan, right? And what I'm saying is that if you do not consent to that term, it's in the terms and conditions. So, and it'll likely be in the, there's a way they're going to tell us to be showing the some of the key terms and conditions. It's called express, so they have to see and say yes. So it'll be one of those that will be in the express category. And if you don't say yes to that particular one, then your credit application will be denied. So you give us the consent before, not after the default has occurred. Yeah.
Thanks, Kevin. Let's see if there's a second round of questions. Anyone who has a question? before I can throw this over to our CEO Kwame to have a summary and closure. Yes, there's a question from Wang to Fiona. He's saying for an entity being newly granted a letter of no objection by CBK in January 2022, does it still allow to carry out digital lending business and register with CBK within 6 months from March 23rd? I think that's when the regulations will come into play.
Yes, I think that's why they've put that period for 6 months. So you'll continue, but if they reject your application, then I think you cannot, like that's it for you. But if they've still not given you feedback, you continue operating for the 6 months. But after that, then, yeah.
I hope you're well answered. Any other questions, anyone? Okay, so on my behalf, as Kwame is preparing to come on, I would like to thank you, Mr. Mutiso and Fiona. So over to you, Kwame.
All right. Good morning, and thanks, Steve. And I think the way to finish this is just to allow both Fiona and Kevin. So I'll start with Fiona. Any concluding remarks, and then I'll just close the meeting. Shall we start with you, Fiona? Anything that you'd like to? Any remarks? Final remarks?
For me, I just think I'm welcoming these regulations because of the fact that for a really long time, this space has been unregulated. Yeah, and we'll also just do a brief on this and then share. Thank you.
All right, thanks. What about Kevin?
Can you? Sorry. So I'd like to echo what Fiona has said and add that I hope that our experience as the Digital Lenders Association of Kenya can be used as a case study for other sectors in the technology space or in the cutting edge ecosystems on how to engage government. One of the key learnings and a big learning for me, and I keep every forum I go to, particularly Kenyan ones, I try to say, and I make sure I say, is that government's not as bad as you think in the sense of, all the horror stories we hear. Most of the time, what people in government want is solutions to the problems you highlight. So going to them and saying this is a bad idea is not what they want. What they want is this is a bad idea because, and this is the solution we think you should consider. And what you find in government is that they're technically very, very, very clever people and can do the research on the solution and then give you feedback on that. But if you expect, because of the amount of work, for example, Treasury or CBK has, if you expect them to give you the solution, it might, because they're not in the industry, they might not be able to deliver what you want. So I'm challenging everyone in cutting edge industries in Kenya to engage government proactively for their sector. That's it. Thanks, Kwame.
Right. Okay. Thank you very much, Kevin and Fiona. But I think the question of digital lending and its regulation is one that the IE has followed for quite a while. And I think we have two reasons. One of them is that there are legitimate reasons for digital lending. But from my basic economics one, the idea is that digital lenders are completely different from banks, and trying to use the same method to regulate them is completely wrong-headed. The first reason being that digital lenders actually take a risk with their capital. People who run banks do as well, but remember, there's a higher reason to regulate banks because banks also take deposits. Digital lenders don't take deposits. Meaning that the person who's running a digital lending enterprise, right, is actually taking a far greater risk, and therefore equating the regulation of digital lending with banks, as the Central Bank of Kenya argued early and went before Parliament, in my view, is completely wrong-headed, has no role, has no foundation in the economics of regulation and even historically. So that's a part. I think, however, that there are reasons, as Fiona mentioned, for consumer protection, but also to stabilize the industry and provide for safety, and obviously a mechanism for solutions generation, as Kevin has spoken. The regulations, in my view, are too wordy. It could have been shorter. Well, it's one of the shortest, to be honest, still. They're too wordy. They could have been shorter, but I agree that the law that was passed as well, that's the nature of Kenyans. I think we tend to go overboard with laws and also want to regulate everything. To the extent that is possible, if this brings back confidence in the public on digital lenders, I think that's a worthy thing, because digital lenders would not exist if there was no demand for the services that they supply. And obviously, there have been complaints around some of the things that have happened, such as basically shaming and protecting. But that's the reason we have government. So just because two people have shamed somebody because she or he owes money and therefore spoken to the parents or somebody else for that, obviously is not an acceptable way of regaining, or rather of claiming back cash. But remember that a digital lender has placed his capital in, and they're entitled to use some legitimate methods to recover. I agree as well with what Fiona stated, that referring a defaulter to credit reference is legitimate. And obviously, as Kevin clarified, one of the things that happens is obviously it happens as part of the consent when you start this. So it is now understood that there's parameters against which government considers a contract between a lender and the recipient of loans regarding digital loans exists. I'm glad that it's been defined. The greater we have all these laws brought in clarified ways, the better. So we are definitely in a much better space, even if my personal preference and the IEA is usually to use very simple methods of regulations. I'm not too sure that the requirement of a fit and proper test, which applies to banks, where directors of banks could lend themselves money from their receipts of the savers, is the same method that we should have applied to digital lenders here. Of course, it's truncated a little bit, but I'm thinking that it's a bit more stringent than it is. The things that needed to be taken care of are the asymmetry of information and some of the questions that should have been raised. But regardless, I think we need to continue to watch this. Digital lending, in my view, is here to stay, and I have no interest in any one of them. It's a good thing. They apply and provide flexible methods of lending to people in the short term, which banks do not provide. And so therefore they are adding to the competition in the lending space, to use the trendy terms. So for that reason, thank you very much, Kevin. We are glad that you took the opportunity to be here. And thank you very much, Fiona, for also providing the foundation for us to understand under what circumstances, or rather, what is the rationale and foundation for regulation, and especially in this industry. And for the rest of you who took your time, I think there are about 20 or 30 people who took the time. My colleagues at the IEA, thank you for being here, and we hope that this opportunity has provided us, this discussion has provided us an opportunity to learn a little bit more about the economics of digital lending, why you need to regulate them, and what the status of law is today. Thank you very much and have a good morning.
Yeah.
against which government considers a contract between a lender and the recipient of loans regarding digital loans exists. I'm glad that it's been defined. The greater we have all these laws brought in clarified ways, the better. So we are definitely in a much better space, even if my personal preference and the IEA is usually to use very simple methods of regulations. I am not too sure that the requirement of a fit and proper test, which applies to banks, where directors of banks could lend themselves money from their receipts of the savers, is the same method that we should have applied to digital lenders here. Of course, it's truncated a little bit, but I'm thinking that it's a bit more stringent than it is. The things that needed to be taken care of are the asymmetry of information and some of the questions that should be raised. But regardless, I think we need to continue to watch this. Digital lending, in my view, is here to stay, and I have no interest in any one of them. It's a good thing. They apply and provide flexible methods of lending to people in the short term, which banks do not provide. And so therefore they are adding to the competition in the lending space, to use the trendy terms. So for that reason, thank you very much, Kevin. We are glad that you took the opportunity to be here. And thank you very much, Fiona, for also providing the foundation for us to understand under what circumstances, or rather, what is the rationale and foundation for regulation, and especially in this industry. And for the rest of you who took your time, I think there are about 20 or 30 people who took the time. My colleagues at the IEA, thank you for being here, and we hope that this opportunity has provided us, this discussion has provided us an opportunity to learn a little bit more about the economics of digital lending, why you need to regulate them, and what the status of law is today. Thank you very much and have a good morning.